Welcome back. As crypto popularity continues to grow throughout the country, a new NBC poll shows that 1 in 5 American adults have invested in, traded, or used cryptocurrencies. And of course, what comes with buying and selling anything? Or reporting them on your taxes. That's right. Even crypto exchanges need to have tax filings associated with them. Joining us now as part of our Taxes Made Simple series presented by Tax Act is Rick Edelman, the Digital Assets Council of Financial Professionals founder. Rick, it's great to have you on the program. Let's say, for example, you made some nice gains off of flipping some Ether or some Bitcoin this year. How do you have to approach that if you haven't already filed your taxes headed into the last few weeks of the season?
Well, the good news, Brian, is that the rules are clear, and so you treat your crypto the way you treat your stocks. If you sold them for a gain or a loss, you report that gain or loss, and it's really that simple. If you held it for less than a year, there's one set of tax rules. If you held it for more than a year, it's another set of tax rates. But it's just like handling stocks. The key is as you noted, you do have to report these gains and losses on your tax return. The IRS is convinced a lot of Americans don't realize that.
Rick, you said it's just like equities here, but it's actually not as simple. We've got this chart here that points to all of, as you've described it, sort of the crypto events that can surround what's specifically taxable. So let's start with NFTs here, because it's not just about buying an NFT if you create one too. I mean, how should we be thinking about that part of the equation?
Yeah, you're right, Akiko. Although buying and selling crypto is simple and easy like stocks, there are new inventions like NFTs that the IRS has never contemplated before. Here's the deal. If you create an NFT, there's no tax liability. Think about an artist who creates a painting. There's no tax liability when you create a painting or when you create an NFT. But if you sell that NFT, that's when the tax is going to be due. And if you then have the person who buys your NFT sell it themselves and you earn a royalty, that royalty is also taxable. So you do have to pay attention to whether you're selling NFTs or earning royalties from them.
Okay, Rick, but let's say, for example, you're wondering, okay, I'm totally down with reporting it as the law says I need to, but how do I do that exactly? Because with let's say, for example, brokerage like TD Ameritrade, you flip some stocks, you're going to get a 1099. Should you expect to get one of those from Coinbase? But, let's say, for example, you flipped an NFT of a monkey. You're going to get a 1099 for that, or you're just going to have to write down exactly how much you made off of the sale?
Brian, you've really nailed it. This is the problem, is that most people who are trading in digital assets are not getting 1099s because there's no institution to provide them and no current law to require them to do it. Some of the big firms, like you mentioned, Coinbase, will manage this for you, but most are not going to do it. You're on your own. And that means the record keeping is your responsibility. Here's the good news. There are several tax tracker services that will do this for you. They will manage and monitor and handle the reporting. They'll even pre-fill out the IRS forms for you. At DAC-FP, we have a list of those tax tracker services that you can subscribe to. And so if you're not going to manage this paperwork record keeping on your own, it makes sense to hire someone to do it for you, because the more often you trade, that's a big paperwork nightmare.
Rick, I want to get back to that number Brian just mentioned from the NBC News poll. 1 in 5 American adults who have invested in or traded crypto. Is there a number here that we can point to in terms of the revenue that's likely to come in this year from crypto trading, from NFT purchases? I mean, the list goes on.
Well, I'm not so sure there's going to be a huge amount of revenue generated for the IRS and taxes, and here's why. Half of all Americans who own Bitcoin bought it in 2021, and they've lost money. Because remember, last year, Bitcoin hit a high of $60,000 and it then crashed 50%. Most Americans who bought Bitcoin bought it near the high, which means they've lost money. So if anything, they're going to be claiming a capital loss on their taxes, entitling them to a $3,000 tax deduction. Those who are more serious about this, more knowledge, more experienced, understand that Bitcoin and other digital assets are a long-term investment. They either haven't sold, therefore there's no tax liability to report, or they are long-term investors, and as a result of that, they aren't paying or declaring their capital gains yet. In the long run, there's going to be a massive windfall to the IRS as eventually these profits are realized. But for the moment, I'm not so sure that the IRS is going to get a short-term windfall. I will tell you this, crypto investors have proven to be the most generous in all of America. People who own digital assets are donating more of it to charity than any other donors. So those who have made big windfalls in crypto, rather than paying the taxes, they're donating it to charities across the country. And that's proving to be really valuable for those charities that need the funding.
And then lastly here, I want to ask you kind of about the free crypto that some people have gotten with a lot of these new technologies, right? I mean, there have been airdrops of tokens like ApeCoin, for example. There have been a free Bitcoin that has just come with, let's say, for example, signing up for some wallets in some cases. Is that also something you have to report, or you only have to report it if you liquidate those free tokens or crypto?
So this is part of the bad news, Brian. These are new. These airdrops and forks, this is new to this new technology. We've never had anything like this before. And as a result, there are no rules. There's no regulation and no legislation. The IRS hasn't yet said, how do you handle the tax reporting and tax payment for your airdrops and forks? The general consensus among accountants is that you have to declare this as income when you receive it and have control of it. And later, if you sell it, you're going to declare that as a capital gain or loss. In other words, airdrops and forks could generate a tax liability when you receive it and another tax liability when you dispose of it. So you should talk with a tax advisor who's knowledgeable about crypto to help you figure all this out, because there are no clear rules yet from the IRS.
Rick, I feel like we need to host an hour-long webinar on this. I mean, there's so many questions around crypto and taxes, but appreciate you hopping on today. And of course, we'll have you back on the show as always. Rick
and that's
Edelman,
why, Akiko, we've created a 2-hour seminar at DAC-FP exactly on this, because it takes 2 hours to explain the whole thing.
There you go. You got the plug-in. Rick Edelman, the Digital Assets Council of Financial Professionals founder. Good to have you on.